Suresh Nair was reading a newspaper. There was news that bond yield is continuously rising. Financial experts are predicting that in the first 6 months of 2023, 10-year bond yields will go above 7%. He was confused. What is this bond yield? Just like Suresh, most of the people don't know much about bond yield and how they impact your pocket. So let us understand this. Basically, if the bond yield falls, then bond price increases. In this, there is a fall in the net asset value of debt fund. Government securities comprise big chunk of debt fund investments. Investors should keep in mind that in lieu of higher return, they should not invest in an asset where there is high credit risk. Now you might be thinking, what is this credit risk? Credit risk arises when you expect that the lending company or bank may bear a huge loss, because borrowers were either not paying the loan or not honoring the contract. Now, the debt fund aims to maintain stability so that there is minimal loss during volatility. So how can investors prevent the losses? If you want to invest in a stable, secure and liquid debt mutual fund, then you can go for a banking and public sector debt fund. Now Suresh wonders, what kind of funds are these? PSU and banking funds are open-ended debt funds that invest 80% of capital in debt instruments of banks, PSU, public financial institutions and municipal bodies. Debt instruments in the portfolio of bank and PSU funds have a rating of AAA or above. Fund managers specifically focus on buying the best performing debt instruments of Navratna or Maharatna companies. So, should Suresh invest in them? Investment in bank and PSU funds is safe because they invest in public companies. So there is a lower risk of default. That's why this fund is popular with risk-averse investors. Even the investors looking for stable return invest in them. This is because there is a regular dividend in them. What's the expert opinion? Vice Chairman of GCL Securities Limited, Ravi Singhal says, funds of these categories have given an annual return of 6 to 8% in the last 3 years. So if someone wants to take a risk, then he can invest in this. These funds give a better return than fixed deposits, Money9 suggests. Banking and PSU funds only invest in banks and public companies. So there is a very low risk in them. These funds give a better return than a savings account or fixed deposit. With twin benefits of security and liquidity, this fund is a great option even during volatility. If we talk about long term, then this fund has performed better and given more stable returns than other funds like short duration fund, dynamic bond fund and gilt fund. How do banking and PSU debt fund works? To understand this, watch Formula Guru.